Good afternoon and welcome to Investing Confidential, where we're going to try to give you insights that are really not available through places like CNBC or even in TikTok or Twitter or anywhere else. Everyone's focus is on the US right now because the market is sliding. We've seen the market basically be up this morning and then come off, and the market's been coming off probably for the last 3 or 4 weeks since we've came off that big rally in July. What's the current situation? Well, we know it's obviously interest rates are causing the dollar to rise, are causing major dysfunction in the capital markets. And as a result, we've seen the US stock and bond markets just get pounded. There's no really signs of a bottom yet. I think a bottom is coming. A trading bounce is coming. There's trillions of dollars in the sidelines, billions of dollars in the sidelines, whatever the number is, doesn't matter. There's a lot of cash. And certainly you've got markets that are oversold, and you could have a massive rally like we saw in late June into July, or you could get some type of 1 or 2 day event which could just destroy anyone who's short. So just be cautious that a rally is coming. The timing is soon, maybe not today, not tomorrow, but it's very soon. But today I'm really going to focus on China. And I think that China is something that I think most people don't understand. They know it's important. They know the country is obviously every day China's in the news affecting something. And I think it's important for people to understand what's really going on in China. I have been into China many times. I've invested in many sectors in China: tech, resources, mining, etc. I know China pretty well. And I just want to give you my thoughts on the current situation, what I think caused the current situation, and what are some of the things that are happening that could happen in the future that could create even more volatility in today's market. Here's what's happening. Growth outlook is being reduced dramatically. Okay, that hasn't happened in the last 20 plus years since China has joined the WTO. China's been the fastest growing economy for the last 20 years, growing, anywhere from 12 to 15, 16%. Compounding annually. China, all that 20 plus years of compounding basically saw China grow to the second largest economy in the world. And if you listen to the talking heads a few years ago, China was going to overtake the US. Well, that's not going to happen anytime soon. And it's today the World Bank, or the last couple of days, the World Bank reduced their growth outlook to 2.8%. Why is that significant? China, again, has been growing so fast for so long that if you talk to experts out there, 5, 6, 7, 10 years ago, they tell you that a Chinese recession is China growing at less than 3%. This is what the World Bank, and the World Bank is always bullish. They're never going to downgrade a country's growth unless they really have to. I mean, the investment banks are all around 3%, Goldman Sachs, Merrill Lynch. I mean, they're going to say China's going to grow as fast as it can because they get a lot of business from China. But the bottom line is China is in recession. It's never going to show a negative GDP growth, but based on relative growth history, China is in recession today at a growth rate of below 3%. And put that in perspective, we're looking at China growing the slowest growth versus the rest of Asia for 20 plus years, maybe 30 years. And that's pretty significant. So we're talking about, countries around Asia, smaller countries that benefit from China. Now China's growing even less than these countries. They're one of the slowest growth rates in all of Asia, which is really unprecedented. I mean, you wouldn't have thought that, 2 years ago, 5 years ago, 10 years ago, you would have said I'm crazy if I made that prognostication. And there is evidence not only of slowing, but also economic distress. And that's another thing no one would have ever guessed, that we'd have economic distress. You can look at factors like shipping rates. Okay, Shanghai shipping rates are plummeting. That's part of the fact that things have been, loosening up since the pandemic, but also the fact that, China shipping rates historically have been a sign of China's strength. But this time around, it's different. There just isn't any import-export growth, and we're seeing these freight rates suffering now because of it, making a full, turn, and now going to probably rates that we had prior to the pandemic, which is pretty significant. Now we look at how China is looked at in the global perspective in terms of financing. There's been a lot of problems, as you know, in the news about Chinese stocks listed in the U.S. Now for Chinese companies, the really only access for capital they have is within their own markets, what they call the A-share market. There's just not much interest in China these days outside of the bond market, and we'll show some of that in a little bit. But there's just a lack of interest for Chinese growth companies. China has an equity culture, not a bond culture. They like to finance everything with stock, and as you can see, there's just no interest, which is not good for China because they finance their growth through foreign investment. Wall Street is very cautious on China. First time in my memory, Wall Street has made a fortune off China. They make a fortune off China's growth. They make a fortune off China, period. So for Wall Street to be cautious on China says something, because they're not going to be they're never very negative. So if they're negative, that means it's worse than what's really out there. Look at some other news. Apple moving businesses now, moving their China operations to India. There's a lot of reasons behind it, but certainly the corporate moves out of the international corporate moves out of China is not good for China's growth prospects, for unemployment, all of this. And that is really worrying the Chinese Communist Party, because the most important thing for China is not what happens in the US, it's not what happens in Europe, it's not what happens in Japan, it's what happens internally, right? So the internal issues in China are more dire for the Chinese government than anything that the US can do to them. Now, one interesting thing to also see is that China is pulling back on this Belt and Road Initiative. Now, this was the press, everyone making a big deal that China was going to throw trillions of dollars in this Belt and Road, and they were going to take over the US, take over the world. Well, come on. I never believed it, because at the end of the day, China only did Belt and Road because they wanted to bring resources back into China. They don't have an expansionist. China's never been expansionist. They've always been about going into a country, extracting things, and bringing back to China. So pulling back on Belt and Road, they've spent a lot of money. They're pulling back, again, showing signs internally that China is in economic distress. Let me go into the reasons why. And it goes back to what you've probably heard of before, that the talking heads played down when it first came out, the whole collapse of the Chinese real estate industry. It started with a company called Evergrande. And Evergrande was one of the largest Chinese real estate companies. It was also the most leveraged Chinese real estate company, massive leverage. And again, the leverage coming from banks, and all the banks in China are owned by the government. So certainly the government had an influence on the growth of the real estate industry. And why the Chinese use that. The real estate industry in China has been the engine for growth for 20 plus years. So how do we grow? Well, we need to move people from the farms into the cities. How do we do that? Well, we just gave them some land. Now we're going to buy it back, and we're going to use the banks, and we're going to use the local governments and incentivize them to grow fast. So the Chinese central government would go to districts, municipalities, small cities, and give growth. Hey, you need to go 20%, you need to go 15%. And this is how you do it. The platform was go in, get some land, give it to a developer or sell it to a developer, and then finance that developer and let him build houses, let him build mixed-use properties. And this is how China grew. They basically forced or incentivized, more importantly, incentivized development and created, giant cities from nothing by giving land away, buying it back, financing developers, building apartments, building manufacturing, building all this, moving people back into cities, moving people into manufacturing jobs, become a manufacturing power and eventually innovation power. And that's how they grew the country. So going back, this is all based on real estate speculation, real estate development. And it worked. It worked fantastically up until it didn't, which was a few years ago. All of a sudden, you've had this large company called Evergrande, had major financial issues, massive leverage with banks, massive bonds outstanding. They couldn't pay their debts anymore because essentially they overbuilt, there was no interest, boom, collapse. And this has spread. There's been contagion. So the Evergrande situation has spread amongst hundreds of developers. And what happened after that? You had people that were historically, putting their wealth in apartments, speculating in apartments. And by the way, the Chinese love to buy apartments and never rent them. Okay, so there's no real estate tax. There was no carrying cost. Chinese investors do not like to rent their apartments out for many, many reasons, but mainly because if someone they rent to has bad karma, they feel that they'll never be able to rent the apartment again. So it is what it is, but Chinese do not like renting, historically did not like renting their apartments. So they would buy them and leave them empty. That's why people would drive by buildings and say, oh, these are empty buildings. No, the buildings are not empty. They're owned by people. They just don't rent them. So that's why there was a lot of misinformation about these Chinese cities that were ghost cities. They were not ghost cities. They were just investments, and people don't like to rent. But chickens come home to roost. Too much building, not enough investors, and all of a sudden you get what they call mortgage strikes. People were very disinterested. People were very worried about their real estate investments because they would, someone would start a development, people would put down payments, and they would own the apartments, then have to put more money and pay the mortgages before they moved in. Well, people said, no more, I'm not paying my mortgages. People would move in. They didn't like the apartments, the shoddy building, whatever the case may be. So there have been mortgage strikes all over the country for the last year or so. And this is very, very significant. You can see it's all over. It's not just in Beijing or Shanghai. And this is causing major cash flow issues for the real estate developers because, again, the real estate developers are all highly leveraged. They owe not only to the banks, they also have bondholders, etc. And so the Chinese banks have a lot of leverage to developers, a lot of loans, and also mortgage guarantees. So the developers would give mortgage guarantees to back the loans. Well, now that the developers are starting to go under, these mortgage guarantees are worth nothing. So the banks have major problems. And so what happens when a bank has problems? Typically, they pull back lending growth, right? So if you look at the loan growth in China, it is decelerating at the worst possible time. But this is actually a good thing over time because you don't want to have banks lending into, bad investments. But this is what's happening today, and it's accelerating this crisis in the real estate industry, which is accelerating, and you're seeing in underperformance of GDP and the decelerating of GDP. Real estate prices are down. They are going down. And this has another effect, which is consumer sentiment. So historically, when things are in real estate markets good, Chinese are out there buying. They buy luxury goods. They buy imported goods. They buy iPhones, etc. When real estate's down as it is today, not only down, but in depression, the consumer sentiment goes down with it. So again, you will see significant guidance drops in companies like Apple and Tesla and anyone who sells anything to the Chinese consumer. All these luxury good companies that have been selling to the Chinese, you're going to see guidance come down pretty dramatically. And again, one of the reasons that no matter if inflation peaks this month or next month or the following month, it's not going to help the U.S. stock market because earnings are going to take big hits because of the lack of buyers overseas, especially China. And that's not going to change anytime soon. So what's the results of all this? Well, you could see that China's trying desperately to change things. As you can see there, they've used the Ukraine war as a reason to export as much as they can to Russia. They're importing as much oil they can and trying to use that as an incentive to export as much goods as they can to Russia because, again, the economy is shrinking and there's not enough buyers overseas, so they need to find other places for their goods. China is investing in places like Mexico. They realize that there's geopolitical situations. Their companies need, believe it or not, Mexico, and this is Mexico from the standpoint of manufacturing, is comparable, if not cheaper, in some cases, than China itself in terms of wages, which is incredible, right? So China is investing in Mexico. China is now the largest investors and implementers of robotics in manufacturing. Again, if you think about it, the whole idea of China was full employment, keep the masses happy, keep them employed, keep money flowing. But now China's putting in robotics because, quite frankly, they were too good in what they did, and now wages are too high in China. So they're investing in Mexico and putting in robotics. And this is all causing major issues internally, social issues. And this is going to result in we're probably seeing it already, a lot of social unrest, which will essentially cause major political shifts in China. I'm not going to get into rumors and innuendos, but certainly there is a lot of speculation. The Chinese leadership is in question. There is big meetings coming up in October. We could see some movements, and I'd be shocked if there weren't any shifts in Chinese leadership because of, again, all of these economic problems that have been happening. The final thing I want to mention is, and what could have the biggest impact of all around the world, is Taiwan. Will China invade Taiwan? At some point, they will. I don't know when that's going to be. It's not going to be anytime soon because of their own internal issues. But China does believe that Taiwan is theirs. And if you study the history of China like I have, they have a legitimate gripe on that. Certainly now, since Taiwan has been a separate country, it's tough to make a call on that from a Chinese perspective. But historically, they do have, that is Chinese territory. And at some point, they're going to go and take it. It's not going to be easy for them. It's going to be a disaster for the rest of the world. I don't know when this is going to happen. The only thing I could say is when you have internal issues, okay, there's an old saying called wag the dog. When you have internal issues and you have the way to get the public, focus on other things is to create an external issue, right? So the Taiwan situation could be a wag the dog situation down the road in the not so distant future for the leadership, the CCP, the Communist Party in China, which controls everything, to try to take the focus off the economy and maybe focus on something that they think would bring the country together. Anyway, that's my 2 cents on China. I hope it was informative. Please hit the subscribe button below. Happy trading.